Hello, do you know what are the derivatives?
Derivatives are complex financial instruments that have value only because they are connected to something else called the underlying asset. In other words, derivatives derive their value from the underlying instrument, which could be stocks, bonds, currencies, interest rate, commodities, etc. On their own, derivatives have no value. The price of the derivative is determined and influenced by the price of the underlying asset.
Are there different kinds of derivatives?
Yeah, the most common derivatives are futures, forward swaps, and options. At the high level of futures, forwards, and swaps are the binding on the holder of the contract, which means the parties that enter into the agreement must fulfill their obligation. Options, as the same suggests, give the option holder the right but not the obligation to buy or sell the underlying instrument.
That's complicated. Can you explain it with an example?
Yeah, sure. Let's say there is a corn farmer is worried that the price of corn will go down by the time crop is ready for harvesting and wants to lock in the sale price at the current market price. On the other hand, there is a popcorn manufacturer thinks the corn price will go up in a few months and want to lock purchase price at the current market price. In this case, corn farmer and popcorn manufacturer enter into a forward contract, which is an agreement for corn farmer to sell and popcorn manufacturer to buy a fixed amount of corn at a future date, say 3 months from now at today's price. This way, they both hedge their risk based on their assessment of the future corn price.
Okay, now we move to the features of financial derivatives.
It is a contract between two parties.
Derivative is defined as the future contract between two parties. It means there must be a contract binding on the underlying parties and the same to be fulfilled in future. The future period may be short or long depending upon the contract. For example, short-term interest rate futures and long-term interest rate futures contract.
Derives value from underlying assets.
Normally, the derivative instrument have the value which is derived from the value of other underlying assets, such as agricultural commodities, metals, financial assets, intangible assets, etc. Value of derivatives depends upon the value of underlying instrument and which changes as per the changes in the underlying assets, and sometimes it may be nil or zero. Hence, they are closely related.
Specified obligation.
In general, the counterparties have specified obligation under the derivative contract. Obviously, the nature of the obligation would be different as per the type of the instrument of a derivative.
Direct or exchange traded.
The derivative contracts can be undertaken directly between two parties or through the particular exchange like financial futures contracts. The exchange-traded derivatives are quite liquid and have low transaction costs in comparison to tailor-made contracts.
Related to notional amount.
In general, the financial derivatives are carried off balance sheet. The size of the derivative contract depends upon its notional amount. The notional amount is the amount used to calculate the payoff.
So, who are these most attractive people who come to buy and sell futures and options contracts? They come from banks, corporations, governments, investment managers, construction planners, farmers, food manufacturers, willing just about anyone in the world to manage the risk in fluctuation prices. So, why do derivatives exist? There are two purposes: hedging and speculating. These two go in hand. If we took one away, there will simply be in market. That because you need both sides to balance the risk. On this side of the trade is hedging. Hedging is performed by the hedgers to protect themselves against the risk, or say to reduce the risk of the changes in the price of underlying commodity. In simply, the act of preventing an investment against unforeseen price changes. Hedging and speculating are different techniques used while trading investing. Speculation is an attempt to earn profit from the changes in the difference between future price and spot price, as they bet on their difference. Hence, the risk is taken internationally to reap profits. To do that, a speculator has to do some very technical strategies. According to price changes, work out his favor, he makes the trades and makes a profits. Hedging controls risk. Speculation depends on risk. Hedgers are risk averse. Speculators are risk lovers.
Types of derivatives. We can categorize derivatives according to their trading mechanism. They are over-the-counter and exchange-traded. Over-the-counter refers to a process of how securities are traded for companies without following any formal obligations, whereas exchange is the marketplace for the trading of commodities or derivatives with a centralized method to ensure fair and efficient trading. According to that, forwards are traded on over-the-counter and futures and options are exchange-traded. Forward contracts. Forward contracts are type of derivatives which help to purchase or sell something on a future date. As an example, he is Mr. John. John is running a cafe. He is worried about the rising coffee bean price. He is buying coffee bean currently at rupees 20 per bag, and he is thinking that it's going to increase up to rupees 35 in month time. Who is coming here to help? Yes, Rosie. Rosie is coffee bean merchant. She contract with John to sell 10 bags of coffee beans at rupees 30 per bag after 1 month. Imagine that after 1 month, the actual market price of beans went up to rupees 34. So because of Rosie's contract, John can buy them at rupees 30 and save rupees 4 per bag. Such customized contract between two parties to buy or sell asset at a specific price on future date is called forward contract. Since they are customized contract, they are non-standardized in nature and they do not trade on centralized exchange. The good thing about forward is that it helps to freeze futures price today and help to manage future risk and act as an instrument to hedge the risk.
Futures. Future contract is an agreement to buy or sell an asset for a certain price at a certain time. Let's illustrate this with an example.
This is Peter. He is a farmer of coffee. This is Jack. He is the owner of a coffee shop. If the price of coffee bean goes up, it is good news for Peter and bad news for Jack. If the price of coffee bean goes down, it is good news for Jack and bad news for Peter.
To mitigate this risk, they enter into a contract. Sell 20 kilos of coffee bean at 1000 rupees per kilo after 3 months. This agreement called future. Seller or short position is Peter. Buyer or long position is Jack. Underlying asset is 20 kilos of coffee beans. Time of the contract is 3 months. Contract price is 1000 rupees per kilo.
Options. This is Leah. She has a car for selling. This is Tom. He wants to buy a car. Tom entered into contract with Leah to purchase car at its current price of 5 million rupees anytime during next 6 months, and he agreed to pay 3000 rupees premium. This contract called option. Let's look at the definition of option. An option contract is an agreement between two parties to facilitate a potential transaction involving an asset at a present price and date.
Consider the following difference between futures contracts and forward contracts. To see the advantage that futures contracts provide trader and another market participants. A forward contract is privately negotiated, non-transferable, as customized terms, carries credit default risk. It is privately negotiated, is fully dependent on counterparty for payment and is not regulated. A futures contract, however, is negotiated in the public market on market exchange, is actively traded, is standardized, having an exchange-specified contract unit expiration, text size, and notional value, is regulated, and has no counterparty risk since payment is guaranteed by the exchange clearing house.
Criticism of derivatives. First one, speculation and gambling. Derivative market function when speculators buy the risk from the hedger. Speculation typically have such a short-term horizon that their trading hurt to the market efficiency in the long run. This is why some people label the derivative as a legalization gambling. Next one, decentralization and systematic risk. Lower transaction cost and lower capital requirement may encourage the speculators to enter into the highly leveraged positions which are too risky, and any advance movement may cause the financial distress not only for the speculators but for the creditors, and it can spread to whole financial system through the process of the contagion. Complexity. Some investors criticize the derivatives for the being too complex and based on the models that are far from the reality. Next one, increase regulation burden. There are complicated contracts, both parties must adjust according to the new rules and regulation. Finally, price instability. There are quick fluctuations in the price, its effect to these derivative market every time.
Here is our group members. Thank you for watching this.